I'm Imran Sattar, Portfolio Manager for the Edinburgh Investment Trust. And I'm supported by a team at Lion Trust to look after the Edinburgh Investment Trust, and Emily Barnard is my Deputy Portfolio Manager. I was appointed as Portfolio Manager earlier this year, but I've been managing UK equity portfolios for over 2 decades. And of course, there have been a multitude of cycles over that period, be that the internet boom and bust, the global financial crisis, Brexit, COVID, and many mini cycles in between. It's one of the reasons why it's important to have a pragmatic investment style. Just like there are economic cycles, there are stock market cycles. So pragmatism is hugely important. I spend the vast majority of my time on bottom-up stock picking. It's where we believe we have an edge, and it's what I enjoy very much. In practice, that means hunting for companies with an advantage, an economic moat, as I like to call it, and ideally operating in industries where there is a structural tailwind, a bit of growth, companies with high returns on capital and the ability to sustain those returns. That's what gets me excited. The trust is essentially looking to build a portfolio of 40 to 50 advantaged companies with attractive total return characteristics. That is income plus capital growth. And it's this total return philosophy which allows the trust to meet its twin objectives of firstly, growing the NAV, the net asset value, ahead of the FTSE All-Share, the UK benchmark, and growing the dividend ahead of UK inflation. And we continue to employ that pragmatic investment style I referenced that has served the trust so well over the last few years. Performance of the trust has been strong since Lion Trust took over the management of the portfolio in March of 2020, both in absolute terms and relative terms. And it's not just across the last 12 months. More importantly, performance has been strong over the 4 years that we have been managing the trust. A closer look at the last 12 months. Again, performance has been strong. I'm delighted by that. It's been led essentially by stock specifics, so the likes of Marks & Spencer's, British Aerospace Systems, BAE Systems, Centrica, and Admiral, all 4 businesses that have produced very strong operational performance that's led to good share price performance. On the other hand, RS Group and Anglo American, they partly detracted from performance, as did not holding RollsRoyce. But the overall performance over the last 12 months has been nicely ahead of benchmark. Perhaps a little discussion around the UK stock market. The headwinds for the UK market over the last few years have been very well documented. Declining pension fund allocations, declining UK wealth manager allocations, Brexit, politics, low growth versus Europe and the US. But fast forward to today, and as you can see here, GDP growth forecasts have narrowed versus Europe. Yes, the US is still a little ahead, but we're no longer an obvious outlier versus G7 economies, perhaps like we were 18 months ago. Politics, not my skill set. I'll own up to that. Political forecasting is not a skill set that I have, but I'd say that political risks at least appear to be receding. And when I look at other regions, again, I don't think the UK is an outlier. Inflation, again, is in the pack. Balance sheets are strong. both at the corporate level and the consumer level. Again, you can see in this slide, when you look at consumer excess savings, we've retained the vast majority of the COVID tailwind that we've had, certainly more than other regions. So, the growth outlook is better in the UK. We're in the pack. Again, on the political spectrum, in the pack, no longer an outlier. And this means that when you look at the chart in the middle of this slide, the free cash flow yield as a yardstick for valuation, that the gap looks stark versus the European region and also the US. And I think that's unwarranted. Over time, it is my strong held view that that gap will close, particularly given the backdrop that I've just outlined, that the UK is no longer an outlier. Now, the other aspect is that there's this perception that the UK market is essentially made up of low growth and lower quality businesses. I strongly disagree. There are many world-class businesses trading on attractive valuations in the UK. The UK market is global in nature, much more so than most regional markets. Returns for businesses across the market, very comparable versus Europe, at least, as you can see in this table again. The UK is home to world-class businesses and brilliant business models. Now, perhaps we don't have the Magnificent Seven. You will have heard of that term, I'm sure, in the press. That's the Metas, the Apples, and the Nvidias of this world. But here at the bottom of this slide, we have 11 magnificent businesses, all listed in the UK. And I'll just touch on a few of these. Compass Group is a global catering business, highly regarded, well known to be one of the best catering businesses out there. It's a market share winner. Ashtead, again, market share winner, clear market leader in equipment rental in the US, high returns, very reasonable valuation. Auto Trader, the car internet platform business, whilst clearly not global, it has the best-in-class business model for internet platforms for used cars. And talk to any car internet platform and they talk about aspiring to become an auto trader. Nice juicy margins, great pricing power, and a moat to protect those returns. Danell, again, not a global business, but a brilliantly run domestic retailer with a model that's not easy to replicate, differentiated, again, market share winner, very reasonable valuation, and a very attractive dividend yield. 3i, a homegrown private equity business that owns Action, a wonderful asset that is the largest European discount retailer. It's been a big winner for 3i, and we think it's very well set to continue to drive great returns. So it's absolutely possible to build a well-diversified portfolio of advantaged businesses, high returns, with good growth prospects in the UK stock market and at a discounted valuation. And I'm very excited about the potential I see in the UK market. To the portfolio, the Edinburgh Investment Trust portfolio. Here's a snapshot of the portfolio. As I've said, a portfolio of 50 advantaged businesses, well diversified across a number of themes. I'll just perhaps focus on one of those themes today. In the bottom left-hand pie chart, data analytics, you can see there, we believe that the value of data, when you add analytics and AI, is increasingly becoming important for businesses, for consumers, and government to make important decisions. We've been increasing our exposure to this theme and have a number of holdings in data analytics. I'll just touch on a few of those. LSEG, that's the owner of the London Stock Exchange. It's not just about the LSE, it's actually a global business, well diversified, mostly recurring revenues. It has a stock exchange, but it also has indices businesses, settlement, clearing, data and information services. A fabulous business with 50% margins, very, very attractive business. Verisk is a US listed data business for the insurance vertical. Again, a fabulous business, great margins, very, very high returns. A good example of a company where we're using the up to 20% allocation to non-UK listed shares. Great business. And then lastly, Admiral. It's a insurance business that I'm sure you will have all heard of. It's a second order beneficiary of data. It's utilizing data, analytics, and AI to make better decisions in pricing insurance risk. A flavor of recent activity in the portfolio highlighted here. We have been taking profits in businesses like BAE Systems, which has re-weighted materially in the last 18 months or so. It's still well set, but we've taken some profits there. Essential, the media business, it sold 2 of its undervalued assets at really good prices, and our thesis there has played out. So we sold a position. And Publicis, another media business, again taking profits into a re-rating. We've we've added to holdings in the UK consumer space, so Dunelm, Whitbread and Howdens, all on very reasonable valuations given their cash generation and then a better outlook for the UK consumer. We've also added to new positions in names that I've just mentioned, so Auto Trader, brilliant internet platform business, as I said, Verisk, again, a great data business, and LSEG, another great data business. And in the engineering space, we've added 2 holdings, new positions in Rotork and Spirax-Sarco, both fabulous UK-based but global in nature engineering businesses with high returns on capital and great growth potential. This is a summary of the Edinburgh Investment Trust portfolio, a well-diversified portfolio of 50 or so advantage businesses, with the trust trading at a discount to NAV of around 11% to an already attractively valued UK stock market that I referenced earlier. So in conclusion, the Edinburgh Investment Trust is a high conviction portfolio with a strong track record, but that's the past. What is the best chance to make this repeatable? Well, it comes back to having a discipline around the investment process, which I referenced right at the beginning. We think that the UK equity market is well positioned to deliver attractive returns given the starting point of valuation and the ability to own attractive businesses that are well set to continue to drive good profit and good cash flow growth. Finally, the trust allows investors to access an attractive portfolio of advantage businesses, the 40 to 50 businesses that I kind of referenced earlier, at a double discount. Firstly, the trust trades on a 11% discount, and then you have the UK equity market discount I highlighted earlier. I'll pause there and open up for questions.
Lovely, Imran, thank you very much indeed. Okay, let's get the questions up on the screen again. If you have questions, you can send them at any time using the questions box in the control panel. First question, have you seen any M&A in the portfolio?
Not in the very recent past, but yes, over the last 3 or 4 years we have seen. And essentially, when you think about Essential, that was M&A because it sold more than 100% of its market cap in the 2 businesses that it sold recently. WGSN, a fashion data platform business, and then secondly they sold a digital commerce business to actually Publicis, So good example of M&A, but there's been plenty of M&A in the market, and we think if these valuations persist, we'll see more of it. Now, the final point I'd make is a double-edged sword, because we own a collection of excellent businesses that we think are going to compound over the next few years. So unless we see a knockout bid that is paying tomorrow's value today, we're inclined to run our position because we're confident in the operational ability to generate more profit and cash flow growth.
And next question, up to 20% of the portfolio can be invested overseas. What's the stock selection process for that?
It follows exactly the same process as when I'm looking at UK stocks. If we kind of look at the shape of the UK market, there are a couple of small gaps, and I referenced data and information services, whilst there are a number of very attractive businesses like the LSEGs of this world. The ability and the flexibility of that 20%, up to 20%, is very useful to be able to buy positions like Verisk. Now, of course, it's a little bit further away from home, and therefore you have to go the extra mile to initiate positions and do the work on the positions. But I do about 3 or so visits to the US, both on the West Coast and the East Coast. And there are a number of reasons why I do that. First is to find these interesting international investments, but also remember the UK market is very global. 3/4 of earnings from the UK stock market are from outside of the UK. And so having a global hat and understanding what's going on, on the West Coast and around the world is incredibly important. So we take that seriously.
And just a quick follow-up for me then, from that 20%, how much are you currently allocating out of what could be 20%? And is that mostly US focused?
Yes, it's kind of a mix between the US and parts of Europe. It's very much at the low end of the historic range. It's about 5% today. It could be higher in the future, but ultimately it goes back to the point I made initially. I'm a bottom-up stock picker. That's where we have an edge, and the 5%, whether that's 15, 20, or 0, is a function of the bottom up. So if we find very interesting US opportunities, we're happy for that 5 to be 15 or 20. But at the moment, the opportunity set in the UK is so attractive, it's very much the bottom end of that.
And a number of people asking very similar question. I'll pick this one to express it. And what could be the catalyst for re-rating of UK stocks?
Yeah, it's a good question. I feel on the one hand, it's fair to say that allocations from pension funds or wealth managers, that is largely done. When I started my career in fund management, the average pension fund allocation to UK equities was 40 to 45%. That number is now 4 or 5. So the vast majority of the allocation away from UK equities has happened, I would argue. So I think small swings in allocation to the UK will help. I think ultimately, though, it's the individual business performance. If the businesses that we own for the trust deliver better profit growth than average, then that will attract natural capital. And the confidence from me is from the operational delivery from the companies that I own in the trust. That's where the confidence comes from. But if we get a bit of a swing in allocation from asset allocators, that would help.
Next question. Your portfolio seems to be mainly large cap. Do you exclude mid cap, small cap, or AIM? I think you have a bit of mid cap and a bit of small cap, don't you? Can you talk through that, please?
Yeah, my philosophy has always been to run a liquid strategy. I think the market in general underestimates the value of liquidity. Don't expect this trust, which is about 1.2 billion pounds. I want it to be liquid, and therefore, you should not expect this to have, lots and lots of small cap exposure. There won't be small cap exposure. There are some very interesting, high quality, good growth, mid cap businesses. And as long as it's toward the upper end of the mid cap market cap range, then that's very much of interest to me. But you should think of this as largely a large cap dominated portfolio, a portfolio of really advantaged large cap names.
Next question is about gearing. Does the trust use gearing, and if so, what are you paying for it?
Yeah, it's a very good question. The gearing is about 10% at the gross level, where debt is marked at par. The way investment trust valuations work is that there's a mark-to-market of that debt. So the net effective gearing is only 3%. But in reality, there's 120 million pounds of debt that has approximately 21 or 22 years left in its term. And I might get the decimal point wrong, but I think it's about 2.4%. So very cheap, very long duration, attractive leverage, and we're very confident that's additive to trust.
Next one about portfolio turnover. And we showed some of the recent buys and sells. What's the portfolio turnover in a given year typically?
Yeah, I guess there are two things to point out there. Firstly, my time horizon is long. When I think about buying a share, I really think about owning a company. That's philosophically how I think about investing. And our information advantage is where a business might be in 3 to 5 years' time, rather than trying to work out what next quarter's earnings are going to be, because I think there the value add is very limited. So naturally, I take 3 to 5 year horizon in terms of how I invest. So expect something like 20 to 25% turnover, reflecting a 4 to 5 year hold period, that order of magnitude. That said, if you have lots of volatility, like around COVID or GFC, we're happy to allow the turnover to rise as we're seeing opportunities. But in normal market conditions, I'm not sure what normal are given the volatility that we've seen in the last few years, but in normal market conditions, expect approximately 25%.
A question asking if you could just confirm what the dividend is, and then also, I guess, probably the management charges as well.
Yes, the dividend yield of the portfolio is in the high threes, about 3.8, 3.9%, and the management fee is around 40 basis points with a total charge of about 50 basis points.
Okay, well, Imran, I think we are then done. Unless you got one more, one more, a cheeky one at the end here. RollsRoyce, is that a regret? And what was the case for you not to buy it?
Yeah, it's it's one of those I've kind of put in the too complex box. Look, you can't look at all stocks all of the time. You have to pick your battles. This is a complicated game. You have to play to your strengths. For the vast majority of my career, RollsRoyce has not been a great investment. It's had complicated accounting, and one that's not been as clear as I'd like. I focus on buying businesses which have great profits and great cash flow, because ultimately it's cash flows that pay the dividend rather than profits. And RollsRoyce in that sense has been complicated. About 18 months ago, it was a turnaround story, and of course I wish I'd owned RollsRoyce in that turnaround story in the last 18 months, and they've done a fabulous job. But I've been kind of observing from afar rather than looking at it in detail. But yeah, a missed opportunity for sure.
Imran, thank you so much. Thank you very much for the presentation and joining us this evening.
No, it's a pleasure. Thank you for having me.